Hello everyone, the metals alarm desk here. Let me say it plainly. You might be asking the wrong question. If the monetary system is cracking the way it looks like it is, then when do I sell my gold and silver might be the wrong question. Because if you're asking that question right now, you might be standing on the deck of a ship that's already taking on water, and you're negotiating the price of the lifeboat. No targets, no hype, just mechanics. If you want more briefings like this, subscribe and turn on notifications. Drop the metals alarm desk in the comments. Follow the metal. Receipts. What the tape. Data says. Gold pushed up toward the high 4800s again overnight. Silver flirted with the mid to high 90s. A billionaire hedge fund figure said the monetary order is breaking down. Long-term government bonds in a major economy got hammered recently, then bounced a bit. Consumer price numbers in the UK ticked higher again. Classification. This is a credibility tape. System stress, bond stress, currency stress. Now, I know exactly what those prints do to your mind. It triggers that voice. This is the top. I should take profits. I should lock it in. I don't want to round trip this move. That voice isn't crazy. It's trained by decades of fiat thinking. Charts priced in a currency losing purchasing power. Sell the rip advice from people who assume the system is permanent. But hold this cliffhanger. What if the thing you're measuring your metals against is the thing that's failing? In a moment, you'll see why that flips. Take profits. And later, I'll give you a framework you can actually use. The mainstream financial world hides reality behind fancy words. They don't say the system is wobbling. They say liquidity event. They don't say the debt can't be paid back. They say fiscal adjustment. They don't say people are losing faith in paper promises. They say risk-off rotation. But every once in a while, someone high up says it in plain language. A billionaire hedge fund figure sat down at a big global gathering and basically said the monetary order is breaking down. Not a little. Not temporary. The order, the framework, the belief system, that's not entertainment, that's a signal. I'm not asking you to worship any personality. I don't care who said it, I care what it implies. It implies central banks are changing behavior, capital is moving differently, old assumptions about safe assets are getting questioned. Here's the part you need to hear clean. When fiat currency is created, it is created as a liability. It's born from debt. There is always a matching IOU somewhere in the system. Gold doesn't have that shadow. Silver doesn't have that shadow. There's no matching promise that can default. No counterparty that can go bankrupt and take your money with it. In plain English, fiat is a promise inside the system. Metal is value outside the promise chain. That's why, when the system gets stressed, people don't run to more promises. They run to what exists. And it's not just retail, it's institutions. Central banks, big money with better timing than you and me. So ask yourself this: why would you sell your lifeboat while the ship is still listing? Now, I know what some of you are thinking. Everything has a price. Surely there's a number where you sell. Here's my answer, and it's the line most people miss. I'm not planning to sell gold and silver for more paper. I'm planning to exchange gold and silver for real assets when the ratio becomes ridiculous in my favor. That's not semantics, that's strategy. Because selling for fiat assumes fiat is the destination. And if the monetary order is breaking down, fiat is not the destination. Zoom out. You don't measure wealth as how many dollars do I have. You measure it as how much real stuff can I claim without begging a bank for permission? Land, a business, productive equipment, inventory, a rental property, a farm, energy infrastructure, a simple stable home with no debt. And the way you move from metals into those assets isn't by staring at a ticker and trying to nail the top. It's by watching ratios and behavior. Clean version: stop asking, is gold high? Start asking, what does gold buy? Now the analogy, because it sticks. We are on a monetary Titanic. Most people keep dancing because the music is still playing. They watch the scoreboard because it still updates. But you can feel the vibration under the floor. You can see the water creeping in through the seams. Gold and silver are the lifeboats. Gold is compact, easier to carry large value. Silver is heavier, more accessible. And it has that everyday money history if the world gets weird. If you knew the ship was going down, you would not throw the lifeboat overboard for casino chips. So when do you sell? You sell when the lifeboat can buy you something better than safety. You exchange it when it gives you control, stability, and long-term productivity. Now we close that first open loop. Here's the practical framework. Simple, memorable, usable. 3 filters. Filter 1, the system signal. If bond markets are breaking, currencies are being devalued, and central banks are hoarding gold. The system signal is flashing red. That's not a time to reduce insurance. That's a time to be careful with what you call profits. Because the classic mistake in a monetary transition is selling real money too early and buying paper claims right before paper claims get repriced. Volatility isn't a verdict. Filter 2, the ratio signal. Instead of asking, is gold high? Ask, what does gold buy? How many ounces of gold buys a house in your area? How many ounces of silver buys a reliable vehicle? How many ounces of gold buys an income-producing asset? If those ratios swing to extremes, meaning real assets become cheap in gold terms, that's when you start exchanging. Most people do the opposite. They buy real assets when they're expensive in gold terms because the currency price feels normal. You won't. Filter 3, the personal signal. Your life matters. If you need liquidity for an emergency, if you're protecting your family, if you have a business opportunity that produces cash flow, then yes, you may exchange a portion. The goal is not to die holding perfect coins while missing a chance to improve your real life. The goal is to survive and thrive. Now, connect it to the market behavior we're seeing. Bonds are supposed to be boring, stable, quiet. So when bonds start moving like meme stocks, that is a warning flare. Bonds are supposed to be the quiet corner of finance, boring, stable, the place adults point to and say, that's safe. More accessible. And it has that everyday money history if the world gets weird. If you knew the ship was going down, you would not throw the lifeboat overboard for casino chips. So when do you sell? You sell when the lifeboat can buy you something better than safety. You exchange it when it gives you control, stability, and long-term productivity. Now we close that first open loop. So when long-term government bonds in a major economy get hammered and then bounce a bit, that isn't normal noise. Some people call that bounce stabilization. Traders call it what it often is, a bounce in a falling market, a breath, not a verdict. Why it matters. When debt loads are gigantic and rates rise, the cost to service that debt becomes politically and economically impossible. So policymakers do what they always do. They either cap rates, print money, or change the rules. All three are bullish for hard assets over time, even if the ride is volatile. Now add inflation. We just saw consumer price numbers in the UK tick higher again. Even if you accept the official number, the point is simple. Cash in the bank bleeds purchasing power. Deposit rates don't truly compensate you after taxes and real-world costs. And if you've ever watched your weekly costs creep up, you already understand the real translation. Prices stop being pounds. They become groceries, fuel, and months of rent. The unit changes, your brain rewires, this is the quiet tax. It hits savers and rewards debtors. Once you see that clearly, you stop thinking of gold and silver as investments. You start thinking of them as stored time and stored purchasing power you can redeem later. Audience mirror. If you felt that take profits anxiety, you're not alone. Now, a word on trading. There's a place for speculation, but in a monetary reset environment, speculation is where people get shaken out. Paper prices can dip, headlines can scare you. That's the point. So separate your stack into two mental buckets. Bucket 1, core protection. You don't touch it unless you are exchanging for a major life upgrade or a generational asset. Bucket 2, tactical. If you're skilled, you can take profits or rebalance, but you never risk your core protection for a tactical win. Now here's the second open loop. When someone at that level says central banks are not holding fiat and debt the same way, you should ask, what are they holding instead? And the answer, based on years of data, is gold. Not because it's trendy, because it has no counterparty risk and has been used as settlement across empires, wars, and collapses. Respect the direction of the flow, follow the metal. Now, the psychological trap. Gold up, you feel smart. Gold down, you feel stupid. That roller coaster is a fiat mindset. In a real money mindset, you measure by ounces, not paper price. Paper price is the opinion of a stressed system. Ounces are the reality in your hand. So when you ask the metals alarm desk, when are you selling? I'll say it again. I'm not selling my insurance policy because the insurance policy became expensive. I'm holding it until the world offers me an exchange too good to ignore. Now the thought experiment. Imagine a future where a decent piece of land can be bought for 1 ounce of gold. Imagine productive farmland priced in gold ounces, not constantly changing currency units. Imagine building materials and labor repriced, and those with real money can build while others beg for loans. In that world, the decision isn't hit a target. It's this ounce buys me a long-term asset that generates value. That's the transition. And it may happen in waves. That's why you don't blow out your whole position. You exchange in tranches as ratios become attractive. And remember, the real world has friction. Spreads, taxes, timing, delays, premiums, availability. A paper quote can change in a second. Physical access can change overnight. So if you ever do exchange, do it with a plan. Not because a headline yelled at you, not because a chart flashed red for 2 weeks. Here's the key point. Profit is not the same thing as progress. Progress is converting stored purchasing power into something that actually improves your life or secures your future. Now we close the what are they holding loop. When trust erodes, gold becomes strategic because it settles without a promise. All right, there's another indicator worth watching, the Dow-to-gold ratio. Take the stock index number and divide it by the price of gold. When that ratio falls, gold is gaining ground relative to stocks. Major regime shifts often show up there. If it keeps compressing, it suggests a rotation out of financial assets into hard money, and it hints at a future trade. If gold becomes dramatically strong relative to stocks, someday exchanging gold for productive equities or real businesses could be huge, but not today, not while the ship is still taking on water, and policymakers still want you to believe everything is fine. Now don't fall into the opposite trap. This is not never exchange. It's don't exchange into weaker money, exchange into stronger assets. Gold isn't the end, it's the bridge to the end, and the end is control. Now silver. Silver moves faster, more volatile. It humbles traders. But that volatility is why silver can be powerful in a transition. When silver moves, it can shock the public, and suddenly the affordable lifeboat becomes scarce. So ask yourself, when silver gets attention again, do you think the average person buys easily, or do they show up late and find delays, premiums, empty shelves? That's why you build before the crowd is euphoric. Now, 2 questions for you. When you think about your metals, do you think in price targets or in what it can buy? And if the monetary order is shifting, what is the first real asset you'd want to exchange metals for? Land, a business, a home, equipment, something else? Now bring it back to the theme. The theme is not gold is going up. The theme is the credibility of paper is going down. And when credibility goes down, people demand higher yields, or they exit. That's a capital war, not tanks, flows. So if you're trying to time a top in gold while the world renegotiates trust, you're playing the wrong game. The better game is to hold what doesn't require trust and wait for the world to offer you real things for it. Receipts, then mechanism. Here's the practical. Do this, not that. Do this. Keep a core position of physical metal you can access. Not that. Don't leverage it or borrow against it just to chase a trade. Do this. Track key ratios monthly. House to gold, stock to gold, land to gold, energy to gold. Not that. Don't obsess over daily moves like it's a slot machine. Do this. Write a plan for what you want to acquire and at what ratio you'll start exchanging. Not that. Don't wait for the news to tell you it's safe. The news is always late. Now expectations. Monetary systems don't break in a clean line. They break in phases. Confidence erodes quietly. Markets send strange signals. Bond volatility, currency weakness, central bank shifts. Then authorities respond with solutions that create distortions. And then almost suddenly the public realizes the game changed. That's the final open loop. It doesn't snap once, it fractures in stages. Now, if you're sitting there feeling pressure to do something, remember this. Doing nothing is also an action. Holding is a position. Waiting for ratios is a strategy. The system tries to shame patience. It calls it missing out. It calls it being wrong. But in a transition, patience is how you avoid forced trades. You want to be able to act calmly when the opportunity appears, not beg for financing in a high-stress moment. So, am I selling my gold and silver? Not into paper. I'm holding. I'm watching ratios. And I'm preparing to exchange into real assets when the opportunities are historic. If you want more briefings like this, subscribe and turn on notifications. Stay close to the signal. This channel is built for mechanics, not vibes. Take care of yourselves. Take care of each other. And here's the question that matters. When the ratios finally swing, will you exchange into land and productive assets, or will you cash out into fiat and trust the same measuring stick that's been shrinking?